Taking out loans for business equipment and vehicles is a common practice. That's why we're going to cover how to record a loan, a fixed asset, and a payment. For example, this business is purchasing a Ford Transit van, which is a fixed asset. They paid $3,000 in cash and took out a loan for the remaining $43,000. What is a fixed asset? It's property or equipment that will be used over the long term. In this case, the van will be used to deliver supplies to customers. We'll start by adding the van as a fixed asset in the chart of accounts. Click on My Apps and then Accounting and Chart of Accounts. From here, we'll click on New Account and we'll name it 2024 Ford Transit Van. The account type will be fixed assets. The detail type will be vehicles, and we'll leave original cost blank. We'll add that using a journal entry further along, and then we'll save. Next, we'll record the purchase of the van. The business used cash and a loan to make the $46,000 purchase. We'll start by recording the cash payment. To add the expense, we'll click on Create and then Expense. And our vendor was Quick Financing. We used the US Bank checking account. The payment date was July 1st. And we're going to select the fixed asset, the 2024 Ford Transit van, because the payment went towards this purchase, and that was for $3,000, and then we'll save and close. We'll create a liability account for the loan. It's a liability because money is owed to the lender, which in this case is Quick Financing. We'll click on New Account, and we'll call this account Quick Financing Van Loan, so that's the creditor and what we're using the loan for. The account type will be long-term liabilities because it's going to be paid off in more than a year. Other current liabilities would be used for debt that's paid off within a year. And the detail type will be other long-term liabilities. We're going to leave unpaid balance blank because we'll add that using a journal entry, and then we'll save. Now that we've added the loan, we'll connect it to the purchase of the van using a journal entry. To add a journal entry, we'll click on Create and then Journal Entry. And our first account will be Quick Financing Van Loan. We're going to credit this liability account by $43,000 to increase it. And our second account will be the 2024 Ford Transit Van. We're going to debit the asset account by $43,000 to increase it. And then we'll save and close. Let's take a look at the balance sheet for July 2025 to see how the van purchase price and loan show up. Click on Reports and then Standard Reports. And then we'll click on Balance Sheet. We're going to change the dates to July because that's when the van was purchased. Then we'll scroll down a bit. And here we can see the purchase price of the Ford Transit van, $46,000. And if we click on it, we can see more details about the purchase. So a payment for $3,000 was made and a $43,000 loan was taken out. Now we'll go back to the summary report, and here we can see the loan from Quick Financing for $43,000. The loan statement for August has arrived. We can see that the monthly payment is $851.45, and that's split between the principal to pay down the loan and the interest, what the lender is charging for the loan. We'll click on Create and then Expense. And the vendor is Quick Financing. We use the US Bank checking account to make the payment on August 1st. We're going to clear out this category. So the principal is going to go to the loan, which is under Quick Financing Van Loan, and that's for $600.62. And the remainder is going to interest paid for $250.83. So the total payment is $851.45, and then we'll save and close. Let's take a look at how the loan balance changed with that payment. So we're going to change the dates to the month of August. And then we'll scroll down a bit. So the loan balance was previously $43,000, and after that payment, it's now dropped to $42,399.38. Let's see how the interest payment shows up. We'll click on the profit and loss statement, and we'll change the month to August. And if we scroll down, here we can see the interest that was paid for $250.83. Since a loan payment is a recurring monthly expense for 5 years, let's set up an expense template that we can then use and edit each month. We'll click on the gear icon and then recurring transactions, and we'll click on the new button. The transaction type will be an expense, and we'll call this van loan payment. We'll make this unscheduled. The vendor is Quick Financing. We'll be using the US Bank checking account, and this is going to be a split expense. So the first line will be for the loan. We're paying down the principal, and the second line will be for the interest that is paid. And then we'll save this template. We received the September statement. We can see that for this payment, $604.12 goes to principal and $247.33 goes to interest. We're going to use our van loan payment template to make the September payment, so we'll click on Use, and we're going to change the payment date to September 1st. Now that we have the September statement, we can add the principal amount, which is $604.12, and the interest amount, which is $247.33. And now we'll save and close. How can we ensure the accuracy of what we recorded? We can compare the loan statement from September with the balance sheet for August. According to the September statement, our loan balance should be $42,399.38 after making the August payment, so that looks good. Using loans allows businesses to purchase vehicles and equipment when needed without having to tie up all of their cash. Knowing how to accurately capture these purchases and record loans and payments is an essential skill that you now have. If you have any questions, drop them below.